Hello and welcome into the KE Report. Shad and Corey here as your hosts, and we're chatting today with our friend and colleague Jordan Roy-Byrne. Jordan is the editor and publisher of The Daily Gold and the author of the book Gold and Silver: The Greatest Bull Market Has Begun, a once in a lifetime investment opportunity. And Jordan, as we've been talking about really all year and last year, obviously the bull market has really picked up steam in 2025. But when we talked about a month ago, maybe it was about 3 or 4 weeks ago, you mentioned that gold was coming out of a recent bull flag, that it may have a little room left to project up to 3950. And you said there may be enough juice to get gold over the 4,000 to 4,200 level, which we did just see over the last couple of weeks, where gold got up to 4,300, almost 4,400. And now we've seen the corrective move. And you had warned last time that whatever happens, we're getting close to an intermediate top. And at that point, you want to keep tabs on what happens in the metals and the mining stocks. Well, here we are, just a couple weeks later, and all of those things have happened. So great calls, by the way. But also, now that we're in a corrective move, out comes the panic. Out comes the calls for the bull market being over. Out comes all the crazy numbers as far as where it'll go on the downside. I'd love to just open it up to you first on, gold or silver. Where do you see support coming in, and how are you looking at this interim corrective move?
Well, as far as support, we definitely have an intermediate degree or intermediate term peak in the miners. If you look at long-term charts of, GDX or the Huey or all of that, you can see rhino horns. So that's not good for the sector. But with respect to the metals, I don't know if the metals are going to have an intermediate term peak or if it's going to be something lighter. So with respect to gold, one level that I am looking at as far as really strong support, I think is 3,600 to 3,700. The initial support before that, maybe I think around, I would say 3,950. Now, silver is more interesting to me because in silver's history, there's basically 3 points when it broke to a new all-time high and then doubled within 6 to 11 months after that. And, based on weekly data, silver twice closed at a new all-time high. Now, the monthly close, that'll be interesting because I don't know if silver's going to close above 50 at the end of October. I mean, maybe it will, but that aside, there was a case, I think it was in 73, when silver pushed to a new all-time high and then it corrected for a little while before it eventually broke out for good. But that's the setup for silver, is that you really could see, based on history, that if you tell me it breaks 50 at some point and it's going to move up from there, in the next couple months, I mean, that could double by next spring or next summer, just based on history. I know that sounds extreme, and I know other people have been saying that, and it is extreme, but there is the setup where you could have that kind of a move in silver. And so looking at the technicals of silver, as I think about 3,600, 3,700 for gold, for silver, I would think about 42, around 42. I mean, you could see 42, 43. I mean, the realistic worst case would probably be, I want to say 41 or a little bit lower. You do have a gap there that is just below 40. So at this point, I think silver will hold that gap. You do have initial support at 46. Is it possible that silver holds above 46 for a while? I mean, that would be really bullish, obviously, if that happened. In 1973, silver bottomed at the 150-day moving average. And when I look at that and the way it's trending and I project forward, so right now it's at about 38, that could probably get to 42, 43 by December, January. So those are the levels I'm looking at for gold and silver. I haven't really looked as much with respect to the miners. And these are just initial thoughts on gold and silver. But, as I like to say nowadays, I know that everybody loves the technicals and they want to get an idea of where things are going in the short to medium term, and that's fine and great. But the big picture is this is the first post major breakout correction in gold. And there will be another leg higher after this, of course. And I think now's the time that we have to look at our portfolios and look for the stocks that we missed, look for the stocks that are sleeping, that might have a chance to really wake up, in the next year or two and, make those huge moves because it's going to be a little bit harder than it was a year ago or so, or 18 months ago. You had high quality top project companies and those types of juniors. They were not trading at giveaway prices, but they were super cheap. And it's great to hold those and buy those when they correct. But, it's going to be a little bit harder over the next year or two, picking the next big winners.
Fair enough. We've seen a lot of stocks revalue much higher. But Jordan, okay, we're in a correction. Yeah, in bull markets, the corrections can be some of the largest down days. But that's also true in bear markets where some of the biggest up days can also happen. Just accepting the fact that this is a correction, as you said, the first correction after a significant breakout. What do you look for either on the chart or in intermarket analysis to tell you that the correction has run its course when it's time to jump back in?
Well, the one thing about jumping back in, I always tell people this, it's dependent on individual companies. So I think this is certainly a mistake that I made in years past, where you're obsessing too much over what's the sector doing versus look at your various individual stocks. I'm sure we all could look and see stocks we like, and there's probably some where we would say, okay, that needs to correct more, it's too overbought. But on the other hand, there's probably some, and I can think of a few that I cover that, hey, it's not too early to buy this because I really like the value. It's got down a little bit. And, if the sector keeps correcting, I'm not going to get killed investing in something like that. So that's the first thing I'll say is focus on companies and stocks individually. Of course, the sector trend is important, but we spend too much time obsessing over that instead of what's the value of the stocks that I'm looking to buy. So again, that's the first thing I'll say. Really good question. With respect to intermarket analysis, it's gold outperforming the stock market. That would be a signal. Gold outperforming the foreign currencies. That's also a signal. I would say with the stocks, because right now the stocks are underperforming the metals pretty badly, but that's fine because they were crushing the metals recently. It would probably be the stocks firming relative to the metals, or you get to a point where we have seen this sell off. We have been going down and we're getting closer to support, and then you start to see down days in gold and silver, and then you see the stocks kind of stabilizing and they're not getting dragged a lot lower. So those are the things I would look for. I'm not super interested in that at the moment and picking the bottom. Again, I'm focusing more of my attention on the stocks, individual stocks, what are they valued, and what would be good levels to buy those at, and how well could they perform over the next year or two based on their value now.
Well, Jordan, just thinking about the stocks and some of our recent discussions and some of the missives you put out to your subscribers, you talked about trimming some of the ones that were pretty lofty and overbought, 10, 20, maybe 30%, and you raised some cash. Are you more likely to wait for pullbacks in those particular stocks you've already identified and vetted out and then just buy them back cheaper? Or are you looking at initiating new positions, maybe in companies that are on your watch list that you missed last run? What are you more animated by?
I would say initiating new positions. And the things that I'm looking at, I really like the value, and I wouldn't necessarily, I don't necessarily need to wait that long or see the miners correct another 10 or 15%, and maybe it'll drag these watch list companies down by another 7 or 8%. I mean, the thing is, if you can find really good value and you think, okay, well, these stocks have a chance to 3x or 4x in the next year or two without needing the gold price to go, from 4,000 to 5,000. And if you're really confident in your analysis, and there's probably a few flaws because that's how you get those values and opportunities. Then if you like the value enough and, the chart is reasonable, you can go ahead and buy those. You don't necessarily need to wait for the sector to correct that much more. So again, everything's company dependent.
On that tone, then, do you like some opportunities in gold stocks or silver stocks? More broadly, understanding, yes, that it's all company dependent, but do you find yourself more attracted to one or the other right now?
I would say gold stocks, just because the pool is so much larger and the quality is higher. With respect to silver stocks, we've talked about it before. It's really difficult. There's just not a lot of high quality assets and companies out there. And yes, some of these have had the ones that have had huge moves, like those will probably require more time to correct. You'll probably see more price damage in those. Those are the ones that can correct 30 or 40% in some cases just because they made huge moves. So yeah, there's just more volatility and more risk in silver and in the silver companies. And I say that understanding what I said earlier, that there's a good probability that silver could be trading at triple digits or close to it by the end of next summer. We could say in the next 12 months. But even that being said, that doesn't change. 5 years ago, I would think, oh, that's great. I gotta buy silver stocks. I gotta, find a silver stock that will leverage that move. And that's great, and that might work in some cases. But now I'm more concerned with, let me find an undervalued silver company or a company that can add a lot more value in the next year or two via exploration or via growing production. And, if I can find those, then their gains will be super leveraged by the move in silver. So that's I think people get it backwards. They think about the commodity and the upside first, and then they go to the company. For me, I know I'm just repeating myself here in every question, but I'm thinking about the company first, and then obviously I have the situation in the metals price and outlook in the back of my mind. But yeah, just the quality. There's just a lot more options in gold stocks versus silver stocks. But you got to do your homework. I mean, like Rick Rule says, do your homework, because if you're looking at silver companies and you really do your homework, you're probably going to find a company, and you can understand it really well, and maybe that's the one that can go up 10x or 15x in a year or 18 months. I mean, it's possible. You have to do your homework. It's not always going to be obvious. When it's obvious to everyone, it's already discounted, and that stock will not have as much upside. But on the other hand, if some of these higher quality silver companies, if they correct 30 or 40%, you could buy those. You don't need to buy a new company. Buy those. That's another opportunity. I know I didn't mention it earlier, because I said that, I favor the newer companies on my watch list that are getting me more excited. But, if the high quality companies correct 30 or 40%, that's a time you could buy those, because that money is going to come. The market is going to buy those when money comes back into the sector. So yeah, I would not avoid that, especially with respect to silver. If the higher quality companies there correct 30 or 40%, yeah, I would jump all over that weakness if I didn't have positions.
Yeah, such a great point, Jordan. When quality goes on sale by that much, why speculate on higher risk when you know you can get a guaranteed run in some of these companies that are more liquid, that have a big following, that already have shown they can run, that have high torque? They go on sale by 30, 40%. Hard to ignore those, but obviously doing your homework, looking for the gems in the rough. When you're looking at the development stage companies right now, we continue to see valuations, especially in the gold developers, that are divorced from reality of where the producers are at. You see ounces in the ground being valued at $50 to $100 based on whatever stage of the economics they're at, whether at a PEA, PFS, or a FS, the feasibility study. But then you look at what producers are making, and we're about to see earnings season. We're about to see the biggest margins we've ever seen in the history of the human race, as far as these gold producers from Q3. And their margins are $1,500 to $2,000, some even higher than that as far as their margins. Why is there such a huge delta between where the producers are and where the next batch of projects that'll become mines are? Are you seeing any opportunities there?
Yeah, I'm seeing one really good opportunity actually, and there's probably a couple others. But to answer your question, because building mines is risky. And so I think, and of course, you have to focus on companies individually. Every situation is different. But the biggest opportunity in my mind, just in general, and yes, it's there right now, find the developers or the late stage explorers that are going to build the mine, but their valuation is low and the market doesn't think they're going to build it, or at least hasn't thought about it yet. Their valuation is low. They're going to be able to finance and build it themselves, because the cost is not super high, and they have the expertise to do that. Like those are always the best opportunities. So again, look for the developers that can finance and actually build their mine. It does, it does take 2 or 3 years, but that's where you get the valuation boost, where maybe they're trading below 0.20 to the NPV of their project, but by the time they build it and they start spitting out gold, that valuation can 3x or 4x. Plus, what if margins go up just a little bit? Then you have a 5 or a 6 bagger just based on that. So that's one side of the opportunity. But in some of those cases, the reason why they're so cheap is because the market has questions about, can they really finance it without destroying their capital structure? Because maybe they put out a study a couple years ago, and yeah, even though there hasn't been huge cost inflation, it's going to be higher. It's going to be more money, a lot more in some cases than what it said in the study 2 or 3 years ago. So you have that. Then the market might have some questions about their expertise. Like when I see companies that say they're going to build the mine, and then I'm looking at their management team, and there's like nobody there with mine building experience. I've raised this point about one of my favorite companies actually, where they're saying they're going to build it, but when I talk to people behind the scenes, they're all saying, yeah, they're not going to build it. They're looking to get acquired. So that's another thing you have to look at. Look at their man. And you don't have to be an expert to do this. Look at the bios of the people involved. Are these production people or are they not? Because in some cases, these companies, they're not going to build it, or if they are, they're going to have to hire, a team of people who actually know how to build mines. So that's another side of it. I think, and then the third reason would be it can take the market a lot of time to catch up to these situations. It's slow. I mean, think about, gold. We made this major breakout 18 months ago out of this beautiful 13-year cup and handle pattern. And it wasn't until gold broke out against the 60/40 portfolio earlier this year when the stocks really started ripping higher aggressively, and especially silver. So the market can be slow to understand. And as an investor, that's where your opportunity is. I mean, you can look, as I was saying earlier, like do your homework, look at all these companies. You can become an expert. There's not thousands of people following these companies. There's not huge analyst coverage for these companies. That's where you can be an expert. You can actually find gems where you're saying, oh, well, this is super cheap. They have, it's super cheap. It's going to get acquired for a big time significant premium, or this is super cheap and they're actually going to build it. They have people who have experience building mines. The capex is not that high. They're going to expand it later. I mean, those are the situations where you can get big wins down the road. So I know there's a lot to take in, but that's how I'm looking at the developer patch right now.
So on this developer topic, then I completely agree with you. Look at management, see if they can build it, see what their market cap is, see what their funding options are. And a lot of these companies have already raised money, see how much more they need to build it. What about size? How much consideration, how much weight do you put into size in terms of what's in their economic studies and what, if they did build it, they would come out of in terms of production per year?
It's critical. The reason size is important is because, again, we're getting back to what is the big money investors, what are they buying and following in the sector, and also the industry. Like when I say, oh, the industry likes it or the industry wants project, those are basically the bigger mining companies who are looking for their future mines down the road. So yeah, I think with respect to gold, it has to be close to 100,000 ounces a year. If it's smaller, does it have the potential to expand to a level that's much higher than that? And I would say you can still make a lot of money, because I know there's a few companies that have done this really well, where they kind of, they have some small old mines and they kind of nickel and dime their way to growing their production. And then you just get one bigger mine in there and they're, producing 150 or 175. And, as you mentioned earlier, I mean, that's real money with the margins right now. Even if the margins go down 10 or 15%, I mean, that they're spitting out real money. But yeah, that's how you can really make big money with these companies. Find the ones that can finance and build the projects that, if they can't produce close to 100,000, then it's got to have the growth potential to go way past that, or it would be something that it's so damn cheap, nobody's looking at it. I'm not looking at it. And you do the math and, well, this could, if it produces 30 or 50,000 ounces, like this can, it's so cheap that if they do that, the stock can go up big time, and then maybe they have another project, they can find another mine on top of that. So that's what I look for. But I mean, size is really critical. I mean, look, there's some of those out there. I mean, I tend to look for the companies that are maybe they're producing 100 and they can go to 250 at some point, or there's probably some out there they're producing 150 or 175 and they could go to 250 or 350. I mean, when you look at those projects, big money will buy those stocks, and you look at the numbers, and I'm telling you guys, I mean, I just running some of the numbers, even just using 3,500 gold, these companies are going to be generating, it's almost like cartoonish levels of cash flow when you look at it. I mean, you have that. And then even with the silver companies now, I mean, I haven't really looked at producers recently for silver, but $50 silver, 40 or $45 silver, you can, even if you're just producing 2 or 3 or 4 million ounces of silver, I mean, that's too small for my liking. But again, you put the numbers together, you could generate some really significant cash flow. So, yeah, there's still opportunities in producers and developers. You have to really do your homework. You have to know where to look. And the other thing I would mention, keep an open mind. You have to look at the whole world, the whole world. I mean, there's certain countries you don't want to go to because they're way too risky. But if you're going to just resign yourself to, well, I'm only going to look at Nevada and Canada and Utah, you're cutting yourself off from a lot of really good opportunities. So you have to keep an open mind about jurisdictions.
Yeah, it's some solid points there, Jordan, for consideration. I guess just another, maybe one last thing to get into is companies that can grow, that have value creation. You're big on companies that can build value. And we've talked in the past about growth-oriented producers, whether they're silver or gold. I agree with you. They're printing money right now, but they can grow in a couple ways. I'm curious which ways you like to see the most. They could grow through acquisition. They could grow through grade, finding a different part of their deposit that's higher grade and using that with the higher margins to really grow revenues. But they can also grow through exploration, using the drill bit and finding new properties, finding satellite pits, going into the underground, lots of different ways to slice it. What areas do you like the most? Because we've talked about the Holy Grail, which is where they're growing production at the same time as growing resources. Anything you'd want to say about growth plans for companies?
Yeah, well, the Holy Grail, thank you for mentioning that, because yeah, I'm thinking about it, and I like the word unicorn, and I like producers, and I think about companies that have the ability to, they can finance a small mine or a decent sized mine. They're able to build it, and it has expansion potential where the cash flow can pay for the expansion. I think that's an example of, so not, that's not the Holy Grail, but I would say that's something that has unicorn potential. Again, it's something that they can finance and build a mine. It's not super expensive, but the mine has expansion potential. So a phased approach, and then the expansion potential basically pays for part of the capital to expand. So there's that, and I think also companies that are just able to, they're able, they have the potential to build a mine that's significant, and then they can use that cash flow to build a second mine. Those types of situations. I mean, I'm thinking about a couple companies, and I don't want to give away names, but just companies that they're able to build a significant mine, and then 2 or 3 years after that, they can build another mine that's significant. That's also a situation that I really like. But every situation is different. And on the exploration side, for me, I haven't looked as much into those more recently. I'm kind of looking at those first two that I mentioned, those two scenarios. But again, just because I'm missing it or not looking at it, it doesn't mean that the listeners can't do their own homework and do your research and you can find something. And again, with the exploration, it doesn't have to be, you don't need to make like a massive Kirkland Lake type discovery. I mean, just something small like a 300,000 of high grade ounces. I mean, that can make a huge difference to even a 2 or 3 million ounce project. So do your homework, but those are the two best scenarios that I would look for. Again, company that's able to finance and build not a huge mine, but a decent sized mine that has expansion potential. The expansion pays for part of the capex. So phased approach to something much bigger. There's that I like. And then a company, secondly, that's just able, it has the potential to build multiple mines that are significant.
Jordan, before we get you out of here, I do want to kind of circle around full circle here. We really didn't spend much time on that whole correction narrative. We're just all accepting that this is a correction. And right now, it very much is a correction. But there are people that are saying the top is in for gold, for silver. That was the bull market. And now who knows if we're ever going to reach those all time highs, at least in the near term. Break down what a true top would look like, what the end of a bull market would look like, rather than simply just a correction that we're all just accepting this is.
Well, yeah, I think that the people who are saying that, I think that's from a place of emotion and not facts and logic. And if we're talking about an end to the whole secular, I mean, you have to think about, okay, when is this cyclical bull going to end versus when is the secular bull going to end? Now, in terms of the secular bull, I posted a thread on Twitter and I just shared a couple charts looking at gold against the stock market, gold against the S&P. Go back 150 years. All the major peaks were at 7, 4, 5, 6, that area. What is it at right now? It's like it's 0.6. So we're not even close. We haven't even seen the real part where U.S. stocks fall into a secular bear, and then all that capital goes into gold and hard assets. So we haven't even seen that yet. It has barely started. We saw a little bit of that this year when gold broke out of a 4.5-year base or 4-year base against the stock market, and that's been really significant. But if you look at that chart, gold against the S&P, at some point in the next year or so, that's probably going to break out of a 10-year base, and then you're going to see a lot more money come into the sector. Gold go to 5, 6, 7,000, et cetera. So we're not even at that point yet. Look at the price of gold it takes to back the monetary base. Now, if you look at the peaks in 1980 and during the Great Depression, the price of gold reached a level versus the monetary base and the gold that we have at Fort Knox that was over 100% backing of the monetary base. The peaks at both those points, well over 100% backing. In both cases, 100% backing now would be a $22,000 gold price. So this is, if you want to call it anything, call it the end of the beginning of the cyclical bull. That's where we are. So yeah, I don't see any evidence that we're at any kind. The worst thing is maybe we're at an intermediate term peak and it'll correct for 5 or 6 months. So, and also this is also why you should focus on individual companies, because there's certainly stocks you could buy right now that have run too far, hit a peak, and maybe they're not going to take out that peak for 12 or 18 months. Versus you could find something that's a really good value, probably has lower risk over the next year, probably has a good chance of going up and getting inflows and buying without gold having to go to 5,000. Those are the stocks that I want to own. Like, that's a way that you can lower your risk. If you're so worried about gold and silver at this massive peak, focus on the companies, pick the right companies and the right values. And once you do that, you're going to worry a lot less about metals prices and worrying and following every little tick. And, oh, it's up this week and it's down. It might go a lot lower. Oh, it rebounded. I missed the bottom. All that stuff is just noise. That's not going to help you make money. And look, I am a technical analyst by trade. That's my expertise. I am telling you that. So you know that there's real weight behind that opinion. I'm not saying completely ignore the day-to-day price action, but you can't get emotional about it. Use it to your advantage. Focus on the individual stocks. Spend more time researching and learning about the individual stocks and less on market timing and macro. And you're going to worry much less about metals prices, which are going to go up a lot anyway.
Well, I think that's a great place to wrap it up, Jordan. Some great comments for people to digest and really think about, that we're just at the end of the beginning, that there's a lot further to go in this cycle. There's a lot of those intermarket analysis clues that you gave out as far as what a top would look like. We're nowhere close. But if you're worried about it, and if you're panicked about every move in the metals price, by focusing on the companies, by focusing on quality, it really becomes more background noise. So don't worry about the macro. Don't worry about every move in the metals price. Focus on the companies that are building value. and they're going to do good even if the metals prices pull back some because they have value drivers pushing them forward. So lots of good comments there. And if people want to get more information from Jordan, definitely click on the link down in the show notes. It takes you over to the Daily Gold. At least subscribe for his free updates that he puts out once a week. But if you want to know the companies in his portfolio that he has vetted and that he thinks are quality companies that have the most upside potential, you want to subscribe to the Daily Gold. Jordan, as always, great having you on the show and looking forward to our next conversation.